You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everybody. Welcome back, Brandon. How are you doing today?
Yo, what's up? I am doing well. Actually, I tell you what, I had KFC for dinner for the first time, the longest time.
Okay.
And I'm glad I'm feeling good today because yesterday night after eating it, I was not feeling good.
Oh, yeah. I mean, fast food is heavy when you eat it for dinner. It's, yeah. I haven't had KFC in a really long time. I lived next to a KFC for a really long time, but I didn't go there. I only went there once, so...
Everybody says when you eat McDonald's, you get the McGurgles, but I don't know what the equivalent is for KFC. But whatever it is, I had the equivalent of the McGurgles last night. But I'm lucky. I'm feeling good now. I was a little bit concerned at one point because I was feeling quite sick. But we're all good. We survived.
Good.
Anyway, how's Melbourne treating you? Are you out of your lockdown? Can you go to the shops yet? Or?
Yeah, we're coming out of it. We've still got some restrictions in place, but it's slowly getting better. So fingers crossed, things will just kind of get better from here, and we don't have to go back into another lockdown. But you never know. We'll
Are you guys
see what
still
happens.
adding daily cases, or are you down to zero now?
Honestly, I don't know about the last couple of days, but they haven't been like growing at a high rate as far as I'm aware.
Okay.
So that's obviously a really good thing. But we've got a few things to talk about today. Big news story out of the US Fed that we'll have a bunch of stuff to talk around, some vaccine news and some information about Michael Burry. He's back on Twitter.
He's back, baby.
We did miss that, man.
Yeah.
And a couple of other things, a bit of a follow-up kind of in relation to corporate tax that we had a big discussion around last week.
Yeah, that'll be interesting. I'm looking forward to that. That'll be really interesting because we spent a lot of time talking about, overseas tax rates, corporate tax with that Facebook story. And then this week, it just so happened that there was a heap of news about G7, that all those countries getting together and talking about the corporate tax rate.
Yeah.
So I think that'll be interesting.
Definitely. All right. Well, with that said, let's just jump into it. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio, and it will allow you to keep track of all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it when it comes to tax time, which is, of course, really important, especially if you're in Australia or New Zealand. We have tax time. The end of the financial year is coming up on us in a couple of weeks' time. So Sharesight can generate up to 10 different reports that can be used at tax time to work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So you can use that link to sign up to a free plan, or you can use it to sign up to a premium plan and get 4 months off a yearly subscription if you do that. So go check it out. And again, thanks to everyone who has used that link to sign up and is supporting the podcast. Thank you.
Yeah, definitely. We do appreciate it. As we say from time to time, that helps us with the ongoing costs of running the podcast. So it's very much appreciated. All right. Do you want to talk about the Federal Reserve first up?
Yeah, I think we should. This is probably the biggest news story that happened this week in terms of people investing in the stock market and things that impact stock market investments.
Yeah, very true. That's the thing, though. It's like when you look on CNBC, this is like front page news. This is the most read article, but it's actually like it's not that big a deal. It's just, I feel like everybody right now is just paying attention to what's going on with these Federal Reserve meetings. That it just even if there's no news, it becomes big news, Yeah,
I mean, so many people.
If that makes sense.
Well, I mean, so many people now, and not just individuals, but big firms as well, will just strictly a big part of their trading strategy is to look at what the Fed is saying and get an impression of what the Federal Reserve is going to do in terms of monetary policy in the future. So it's really a big spectacle, but at the end of the day, it's just sometimes not that much really comes out of it.
Yeah, exactly. The big news is that there's no news.
Exactly right.
But yeah, so let's talk. So if you're not sure, so the Federal Reserve, they meet 8 times per year. I thought it was once a month, but no, it's 8 times per year to discuss monetary policy. And the most recent meeting of the Federal Reserve happened just a few days ago. So there were, just at the top level, some highlights of what was said and done. So the interest rate remains unchanged. Asset purchases remain at $120 billion per month. They increased their forecast for inflation this year from 2.4% to 3.4%. GDP growth this year is estimated at 7% now instead of 6.5%. And forecasts for unemployment remain unchanged at 4.5%. So that's kind of what, I guess, the major headlines at a top level. But the big news out of this meeting is that, well, this is what's being reported on a lot, is that the Fed expects to raise interest rates earlier than what they had previously stated. So previously they stated they were not going to touch interest rates until 2024, so quite a way away. Now they expect that they will raise interest rates at some point in 2023. And in fact, from the meeting, 7 of the 12 Federal Reserve officials see a rate increase sometime next year. And that number, 7 of the 12, is up from 4 out of 12 last quarter. When asked about it, Jerome Powell, he said, "You can think of this meeting that we had as the talking about meeting." Powell said in a phrase that recalled a statement he made a year ago where he said the Fed wasn't thinking about raising rates. So they're thinking about it, Hamish Hodder.
I mean, this is how ridiculous that statement is. So ridiculous. And the reason why they're saying that is because people act now on what the Fed is saying, not on what they're doing. And now he's kind of saying, we're not even talking about it yet. We're just talking about it.
We'll talk about it next time.
Like, they know how sensitive what they say is to people investing in the stock market, because it's not as if they come out and say, we're raising rates. That isn't what's going to move the market. It's when they come out and say, we're going to raise rates, immediately the market will move. So they have to be so careful. It's like they're walking around on eggshells to just be careful with what they say and not upset anybody too quickly. But I mean, it's not surprising that they didn't raise interest rates. I don't think. It's also not really surprising that they're continuing their $120 billion per month of printing money and buying mortgage bonds and government bonds.
That's a lot, isn't it? It's a lot.
It is a lot to be doing on a very consistent basis. This isn't this has been going on for quite a while now, and it looks as though like they're intending to continue that for a significant period of time. The most interesting thing out of that, I think, is their inflation forecast, that has risen quite steeply, almost 50%, almost a 50% increase on their expectation of inflation. The other thing that's interesting is that their GDP expectation didn't go up 1% as well, right? Because within that GDP number is inflation, of course. Real GDP would be the GDP minus inflation. So the fact that they raised GDP less than they raised their inflation forecast also means that they're expecting slower growth than they previously saw. So,
okay. There you go.
A couple of interesting things to think about. Yeah.
Yeah. And I do have a little bit more to talk, to say on the inflation side of things, which we'll get to in a second. But yeah, just reading through this CNBC article, it says, as expected, the policymaking Federal Open Market Committee unanimously left the benchmark short-term borrowing rate anchored near zero, but officials indicated the rate hikes could come as soon as 2023, after saying in March it saw no increases until at least 2024. Though the Fed raised its headline inflation expectation to 3.4%, a full percentage point higher than the March projection, the post-meeting statement continued to say that inflation pressures are transitory. The raised expectations come amid the biggest rise in consumer prices in about 13 years. And on that note, so the 12-month percentage change of the consumer price index in the US sat at 5% in May.
Wow.
So yeah, exactly. So think about that. The 12-month percentage change in CPI. So it has changed by 5%. It has gone up by 5% in 12 months. So I had a look at this actually, and that's almost as high as July 2008, where it had a 12-month percentage change of 5.6%.
Right.
How I thought this is interesting because, maybe you could argue something like, the change is so drastic because, I don't know, we saw like massive deflation last year around this time or something like that. And I guess, in fact, the worst change, or the lowest change, was in March 2020. The 12-month percentage change was just 0.1%. So I guess that just means that consumer prices were just flat, and since that time they have risen 5%.
Right.
So yeah, I find that very interesting. Is that right? Does that make sense?
Yeah. No, that makes sense. Yeah. I mean, 5% is astounding, and I think. I don't know, like no one really knows what's going to happen for the rest of the year or going into next year with these kind of numbers, but they're seeing inflation is seeing some big month over month numbers. And I think to me, that's more interesting because it's showing not a comparison to last year, but a comparison to just this year. How are things changing over the course of this year? So to see how that continues for the rest of the year will be interesting, but no one really knows. I mean, you really can't listen to what the Fed says. Don't go, they've upgraded it to 3.4%, but they still say it's not going to last, so it's going to be okay. They have no idea either.
Yeah.
So, I mean, so what we actually are going to see could be anything. So we'll just have to wait and see how it plays out. But so far, inflation has been very, very strong, at least over the past couple months.
Yeah, definitely. And we've been seeing it everywhere. Everybody's talking about it. All the people we follow are talking about it. It's like the number one thing they're talking about right now.
Yeah.
Is how inflation's going crazy. The example I always point to is Warren Buffett talking at the shareholder meeting, how he stood up and said, we're seeing huge inflation in our various businesses in Berkshire Hathaway, steel prices going up through the roof, lumber prices going up through the roof, cost of new housing going up, and they're just passing on the costs. It's just everybody's talking about inflation right now. It's a hot topic.
I mean, and it makes perfect sense. I mean, you have an environment where the cost of debt, the cost to get money, and even equity as well, the cost to get shareholders on board is the lowest it's ever been in history for the longest period it's ever been in history. So it's no surprise that prices are rising. There's no surprise that there is hot economic activity that's forcing prices up and forcing supply chain issues and shortages that cause more price increases. There should be no surprise to anybody who knows a little bit about economics. It's just a matter of how long this will go on for and what other factors will impact the inflation rate over the next couple of years. But we will see.
Yeah, definitely. Should we talk about why investors care so much about inflation?
Yeah, and I think we've probably spoken about this a few times, but I think it's always good to kind of reiterate why is it that we care about inflation. And the main reason why we care about inflation is because of the impact that it will have on interest rates. So interest rates is kind of the main lever that the Fed has at its disposal to limit inflation. So if inflation is getting out of control, the Federal Reserve can raise interest rates, increase the cost of debt, and as a result, that will reduce the flow of money around the country and reduce the economic activity. If interest rates are to rise, then there's a variety of kind of things that happen. The first thing, and I think the easiest way to think about it, is all assets that offer any kind of yield are kind of connected in a way. So they're all compared to each other relatively. So at the lowest end, you have the risk-free alternative that is basically investing in US government bonds because the government has never defaulted on them. So we consider those risk-free. But if the rates on those go up, if the return you can get on those goes up, then the return that you can get on a stock is also likely to go up. So the way you could think of it is, if the US bond goes from 1% to now it goes to 4%, for example, which is extreme. But if it did that, then you may no longer want to invest in a certain stock. You might want to sell that stock and put money into that bond. And that's a very clunky way of explaining it, but that's kind of the mechanic that happens in the market.
Yeah. I think if you zoom out and you look at it at a massively, like you think about all of just the big money that's in the market. I mean, generally speaking, if new bonds become increasingly attractive, then money will start to shift it's like flowing from stocks to bonds. And what we've seen with low interest rates is that the money is now flowing from bonds to stocks. So I think what you're saying, how it's all connected in a relative way, is correct. And when you zoom out to a massive, like a 10,000 foot view of it all, then that does make sense.
Yeah. And the other thing is that most investment firms use the the risk-free alternative, the US government bond rate, as a discount rate in their valuation. So that's the other thing is, as soon as there are actual changes in bond rates and the rate that the Fed is setting, the official funds rate, as soon as there's changes in those, these big investment funds are putting that into their spreadsheets, changing the valuation of the businesses in their portfolio, and then immediately adjusting their portfolios based on that. So that also plays a significant role.
That's a good point. I hadn't thought of that, but that's a really good point. It totally changes people's or big funds' valuation models. I hadn't thought of that, but yeah, you're right.
And that's also the reason why people are so sensitive just to what the Fed is saying, not necessarily what the Fed is doing, because as soon as the Fed changes something like, instead of raising in 2024, we're now raising in 2023, or we're raising in 2022, all of a sudden that also goes into their modeling. Now they're going to be discounting at a higher rate 1 year sooner. And as a result, that's going to impact the way that these big firms value stocks. So yeah, that's kind of the main reasons why. It also has other impacts, of course. I mean, inflation itself has impacts on consumers. It makes it more expensive for the standard of living, or the cost of living, I should say, not the standard. The cost of living goes up for consumers, and that makes things more challenging. And then the raising of interest rates to curb inflation will also make consumer debt more expensive. They'll have less money to spend. Credit card debt will go up for a lot of people and be more difficult to pay back. So that's kind of some of the impacts that we would see from inflation, and then the raising of interest rates as a result of inflation.
Yeah, exactly. No, it's interesting. It has an impact on a lot of different things. But yeah, ultimately, I guess investors don't like inflation in a big way. And the main reason for that is what we're talking about. It means that we control inflation by raising interest rates, and the raising of the interest rates generally hits stocks. It has a whole range of measures, which obviously we just talked about, but long story short, it makes stock prices come off a little bit. But yeah, no, that was good. That was a good explainer. So yeah, kind of interesting. I mean, we've been talking about it for all of like 15, 20 minutes now. Really, there's not too much news out of this. We could have said, the top level stuff in half a minute, rate remains unchanged. They think they're going to raise rates 1 year sooner, but it's still not till 2023, full stop. But it's interesting how, even though that's really all there is to it, once you actually follow that through to all of the different, factors and all the different players that are involved in the market, it actually becomes quite a big story.
Definitely.
But yeah, we might leave that one there. I think that's pretty much all we had to talk about for inflation, the Federal Reserve. Should we talk about following on from what we were talking about last week with all this corporate tax rate stuff, we were discussing how Facebook has its subsidiary in where was it? Singapore.
Yeah.
To avoid paying tax. And now we've had this G7 meeting, and one of the topics they talked about was a minimum corporate tax rate. Do you want to take us through this one?
Yeah, for sure. Yeah, so the G7 meeting, I think, or they're going to be striking a deal over the weekend in order to make some changes to corporate tax rates for those countries. Right. So the G7 meeting, for those who are not aware, is a political forum that's made up of 7 countries: so Canada, France, Germany, Italy, Japan, and the UK. And basically, they're going to get together and strike a deal, or hopefully strike a deal that's going to make multinational corporations, so big corporations that operate in a lot of different countries, to pay more tax. And yeah, as you mentioned, we spoke a little bit about a similar story last week where we were talking about how Facebook was able to basically move their Australian revenue, money that they really do generate in Australia, to move that money to Singapore in order to avoid the Australian corporate tax rate. So in relation to that, we now have this meeting of 7 countries that does not include Australia, but maybe like the beginning steps of some changes that we might see in corporate tax rates over the next couple of years. And basically, in terms of what these big companies are able to do beyond what we spoke about last week with Facebook doing like revenue moving into Singapore, what a lot of big companies do is they put their headquarters in low corporate tax rate countries. So for example, I think we spoke a little bit about this last week as well, but companies like Google, Facebook, Airbnb, they have their headquarters in Ireland. And the corporate tax rate in Ireland at the moment is 12.5%.
Jeez.
Which is...
That's nothing.
Yeah, it's low. I mean, the corporate tax rate in Australia is 28.5%, I think, or 30% if you make over...
It'd be 30% for those ones, yeah.
Yeah, exactly. So it's a big difference if they can put their headquarters in a low corporate tax rate area, and that specific that specific action of putting their headquarters in Ireland allows them to avoid the 19% UK tax rate, which 19% is still quite low. It's lower than the US, I believe, which is at 21% at the moment. But
I mean, I guess it makes sense if you can just move next door and save like, what is it, 8-9% in tax, then you're going to do it.
Exactly. The businesses are going to do it for sure. Yeah. So there's really 2 things that came out of this deal. The first was that the deal would force companies to be taxed in any country where they make more than 10% profit on sales. And according to the article, at that point, the company would have to pay 20% tax beyond the 10% that they made on their sales. The second part of the deal is really interesting. This would be for those countries, those 7 countries, to agree to a global minimum corporate tax rate of 15%. So basically to start the movement of getting countries to honestly really unionize in a way and band together against these big these big multinational corporations and say, let's not lower our tax rates below a certain rate so that these companies have to pay tax in our countries. So the aim really is to prevent countries from undercutting each other to attract corporations, which is something that's accelerated in particular since the birth of the internet. Because if you think about businesses before the internet, let's say the article drew an example to like a steel manufacturer or steel producer. It's very difficult for a company like that to move their operations into a different country.
Yeah. It's pretty obvious, isn't it?
Yeah, exactly. They have a lot of physical assets that make it very difficult for them to move their operations. Whereas something like an internet company can be very nimble and can move their headquarters around the world, every few years if that's what's necessary.
If they need to.
And as a result, it's become much more attractive for countries to undercut each other on tax rates, and that has of course benefited corporations because that means that they're getting a better deal for tax rates in different countries.
Yeah, this does make sense. I mean, as countries, what we were talking about last week, you just want to generate a lot of tax revenue. That's really what you want to do. So it does make sense for them to all come together and say, hey, let's all agree if we do this together, we will all be better off. So, yeah, I totally understand why this happens. And I think it's good that it happens, because otherwise, I mean, if this stuff was left unchecked, then surely we'd get to a point where, I don't know, for example, I don't know what the numbers are, but what'd you say Ireland was? It was like 11%?
12.5, yep.
12.5, and then Singapore goes 10, Australia goes 8, US goes 5, and then all of a sudden no corporations pay any tax because there's just consistent undercutting. We get into imagine if we got into this environment where it was just like, just companies just did not pay tax at all. That'd be insane.
The country starts paying the business to stay.
Yeah, exactly. Please stay, because if it was just left unchecked, I guess that could happen, because it's like if the company stays in that country, then they're still employing the citizens of that country. They provide a lot of jobs, which is helpful politically. So yeah, that would just be the most bizarre situation. But it does make sense that these countries get together, shake hands, and go, yeah, let's make sure that we all agree to tax them at least, say, 15%.
Definitely. The US within the group of 7 nations is pushing particularly hard on this deal. And it kind of makes sense. Biden has made it very clear that he wants to raise the corporate tax rate from the current 21% to 28%, which would still be below the 35% that it was previously. It's actually kind of crazy how much their tax rate went down under the Trump administration.
Yeah.
35 to 21 is a huge drop. The US basically went from being one of the highest corporate tax rate countries to one of the lowest in a single year, which is kind of crazy. But Biden wants to raise that back up to 28%. And that's kind of part of his plan to pay down some of the debt and cover some of the cost of the increased level of stimulus that's been necessary over the past couple of years in order to help individuals and businesses. This deal would hopefully prevent countries from competing in a race to the bottom in attracting big tax-paying corporations.
Yeah, no, so true. So true.
Yeah, it is difficult because it's an interesting situation to me, because these businesses are so flexible in how they can move around, and that is something that is brand new. So it kind of makes sense that there would have to be different rules that apply now than they needed to be in previously.
Oh, definitely.
In the article I was reading, I read a couple of articles about this, and one of them raised a couple of problems with this kind of deal. And I think these are fairly common sense things that will be problems in order to get this through. But the first is, of course, that it's just difficult to get 7 nations to agree on something, particularly when those countries are basically agreeing to give up some of their sovereignty, to give up some of the power of control over their own country in a way.
That's a good point.
Because they're all saying, hey, we're all going to agree to not change laws in this way, whereas previously we could have. And that is going to be difficult enough, let alone expanding the deal to include all countries, right? Because this deal doesn't really... It would help a little bit, but it wouldn't really help unless the vast majority of countries got on board. Because if only 7 nations agree to not lower their corporate tax rate below 15%, but then Ireland, for example, doesn't join and keeps their tax rate at 12.5%, then no one's going to move out of Ireland. So
yeah, exactly.
That's probably going to be a pretty challenging thing for these countries to overcome over the next few months, I guess, as they try and get more countries on board with this. But the biggest concern, and this was something I hadn't really thought about too much, but the biggest concern, according to the person who wrote this article, was the kind of impact that this would have on developing countries. So for wealthy nations, say like the US or the UK, that have really strong and trusted currencies, it's really easy for those nations to get stimulus in the form of debt in their own currencies and give it to the population. And we've seen that in Australia, for example, as well, where there's just been a huge increase in debt and we've been able to get stimulus to individuals and businesses. But for a lot of developing countries, that really isn't an option. They can't just take on more debt in their own currency. So the best lever that a lot of developing countries have for stimulating economic growth is lowering taxes and attracting businesses.
True.
So that could be difficult to get some of those countries on board that where this may not be an option for those countries, that the best option they have is to lower taxes and attract businesses to stimulate economic activity when it's not there already. So that was an interesting thing that I hadn't thought too much about.
Yeah, I just had a quick look at at Singapore's response to this G7 proposed tax rate. It says, responding to the G7 agreement, Singapore's finance minister Lawrence Wong said in a Facebook post that the city-states authorities would make any necessary changes to the corporate tax system when a global consensus is reached.
So never.
Yeah, pretty much. It's like, well, you guys, you figure it out, off you go, figure it out, and then we'll see what happens.
In the meantime, we will keep all of the multinationals here.
Yeah, exactly.
In our country.
Pretty much. I'm just trying to read. G7 agreement spells bad news for Singapore. It's like, but Singapore's not included in this G7 thing, is it?
No, they're not.
No. So I don't know why it would have a negative impact, but they seem to think it was. Anyway. Can't speak too much about that. I'm trying to read at the same time. That's not going to do anyone any favors. But yeah, very interesting. Yeah. What do you think? Do you reckon that this will end up happening? This 15% minimum G7 tax thing? You reckon it'll go through?
Maybe. Whether it has any lasting impact on businesses, whether they can whether businesses can find a way to get around these kinds of things. Look, they probably will. So I don't know. Yeah. What do you think?
I was just going to say, I interrupted you there a little bit. I think, it makes sense for them to do it on one hand because, a lot of business is just in these 7 economies. So them just doing it anyway will help them. But I don't think it will solve that overarching problem that there are these countries like Ireland or Singapore where it's just very low tax because they're not included. It literally does. If you want to solve this problem of big corporations escaping to little tax countries, then it really needs to be a global minimum corporate tax rate. Otherwise, there's always going to be a way out. But I think overall, it's still a good idea because I guess a lot of corporations just can't help but have operations in these G7 countries. So I still think it has some impact, and it probably makes sense for it to go through. But I still think it's far from closing the tax haven loopholes that the world currently experiences.
Definitely. Take us through what Michael Burry's been saying back on Twitter, because I haven't actually seen this, but I knew that he came back.
Yeah, this is a quick story. There's not too much to talk about here. I just thought I'd include it because Michael Burry is someone that I follow very closely. He was right in a big way when he predicted the downturn of the American housing market in what turned out to be 2007, 2008. But really, he was picking it back in 2003, 2005, that kind of time period, which is staggering. But he pretty much was tweeting a lot earlier on in the year about how America could see hyperinflation and how it's quite likely that we're going to see the world fall apart, to put it lightly. He really was putting forward a good argument and posting lots of detailed charts and examples of how, America was going to struggle and inflation was going to run riot. Anyway, long story short, he basically said, look, I've warned you guys. I warned last time. Everybody said that I didn't warn. So I'm putting it out there. I'm warning you this time. And then he kind of just deleted everything after that. And he said he went quiet. And I don't know, it might have had something to do with, some of the authorities knocking on his door and say, hey, pipe down, please. But he's back. Somehow, for some reason, he's just started tweeting in the last couple of days.
Was it Michael Burry that had those short-term trades on like bonds, those inverse bonds? Maybe he had to take a break from Twitter so that he could make that trade. Maybe it was a really short-term trade. He had to make it, and he didn't want to be posting on Twitter and have any anyone think that he was trying to influence the market or anything.
That's a good point. Yeah.
And now maybe maybe those trades are finished and he's back on now.
Maybe. I mean, you put forth a good argument. He did hold those positions at the end of Q1. I mean, it's getting through almost the end of Q2 now. Right. But I mean, you raise a good point, is that if you started, if he was making a bet based on what he thinks, and then he just kept saying this sort of stuff, maybe he would start getting some knocks on the door about market manipulation. But anyway, he's back, Michael Burry. God, we got to love Michael Burry. He says in this tweet, people always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things by 2 orders of magnitude. Hashtag flying pigs 360. So there you go.
Wow.
That's not really very cryptic, is it? That tweet. I mean, that hits you pretty much smack bang in the face.
Yeah. I think I'm going to start saying that when people ask me what's going on in the markets.
Yeah,
it is
greatest
simple.
Speculative bubble of all time
in all things.
I mean, do you agree?
I don't know if I agree about the all time and all things part, but certainly in some areas that I do understand, I'm seeing a lot of speculative bubbles. There's a lot of high-flying tech companies that are in massive bubbles. There's other areas of the market, things like cryptocurrency, extremely risky markets that seem to pop up when people have run out of places to make high returns in other areas. First, it goes safe stocks or bonds, and then safe stocks, and then really speculative stocks, and then stocks that don't even exist yet, a SPAC, and then and then cryptocurrency. There's a lot of areas of the market that are looking very, very speculative at the moment.
Yeah, no, I agree. I wanted to look into that hashtag to Flying Pigs 360. I didn't really know what he meant when he said that. But I looked up, apparently there's a whole bunch of people discussing this hashtag on Reddit. Yeah. And apparently people are just coming to the conclusion that, it's just flying pigs, which is referenced as just something that can't happen. And then 360 as in coming full circle. So we're back to where we were when, everybody thought that, nothing bad would ever happen. And clearly that's a dangerous mindset to be in. But yeah, I don't know. This is kind of a bit out of the blue from Michael Burry. I guess we'll see if he keeps posting or whether this is just a once-off. But I do get a bit of a kick out of reading his tweets. They are quite funny sometimes. He actually seems quite right-wing on his Twitter, which is neither here nor there. But that's not exactly what I maybe expected from Michael Burry.
Right.
But some of his posts come across as quite right-wing. But yeah, as I say, neither here nor there. I just found that interesting. I got one more story to roll on through. Ooh. Should we keep rolling?
Yeah. What have we got?
I wanted to talk about this because this is just kind of funny and it shows what the speculation that's kind of going on right now. So CureVac, you heard of them?
No, have not.
Nah, I hadn't either. But their shares this week took a dive on the latest COVID vaccine data. So CureVac, this is a company that came onto the market very recently, August last year. Opportune time to do so, I guess. So this company is a biomedicine company and they make mRNA vaccines, or at least they try to. That's their MO. They try to make mRNA vaccines. Anyway, so they come onto the market last year. IPO's at $16. The first trade's at $44. In 4 months, it's up to $136 per share. So at the time, like this company has 186 million shares outstanding. So at the time, this is a $25 billion company. Now, as of yesterday, it has cooled off over the recent months. And as of yesterday, it's just an $18 billion company. And I wanted to chuck this in because this is off of 2020 full year results of 48.9 million euros of revenue and operating expenses of 158.7 million euros. So they're not making any money. Their total revenue is 48.9 million euros. And I guess I guess what that show, and this has been the case of like, what was that company we were talking about? Aerotine International, which is like just a deli that's got a what was 100 million
hometown.
What did I say?
You said Aerotine from Wolf of Wall Street.
Oh my gosh, that's the Wolf of Wall Street. That's what we were comparing it to. Yeah, sorry, hometown Aerotine. Yeah, that's a Freudian slip there. But yeah, this is just another example. It's fair to say that, you know, looking at these numbers, a lot of the investors' hopes are riding on their latest and greatest mRNA COVID-19 vaccine, which is currently under development. And the companies pushing this too, they know it. They know that it's right. So even in their Q4 earnings, they said, we have expanded our manufacturing network with European partners, expected to manufacture up to 300 million doses of our COVID-19 vaccine by the end of 2021 and up to 1 billion doses in 2022.
Wow.
So they're hyping this thing up, right? It's going to be the greatest thing since sliced bread.
Yeah. And I mean, of course, if management expects to be manufacturing that many, they will be manufacturing that many. Like, it's a certainty,
Absolutely.
right? What management says in every company is always true, and you should always listen to it, and you should always trade on it. So
yes,
that's just a little bit of financial advice for you there.
Words to live by. Yeah, exactly right. So they're very bullish on this vaccine. 300 million doses produced 2021, 1 billion doses produced in 2022. And that would be fantastic if the vaccine actually worked. Oh dear. So that gets me to the actual point of this. Yesterday, they released some results of the efficacy of their new vaccine, and unfortunately, it wasn't very good. So have a listen to this from a CNBC article. They say CureVac stock plunged 50% in extended trading on Wednesday after the German biopharmaceutical company released preliminary efficacy results of its COVID-19 vaccine. After the candidate failed to meet the success criteria. The vaccine candidate demonstrated an interim efficacy of 47% against COVID-19 disease of any severity, according to the press release. The company has said final analysis of the results will be completed in the coming weeks. All I can say, bummer.
Man.
Yeah. It's pretty funny, isn't it?
That is pretty good. 47%. Not quite. Didn't quite get the pass. I love how they've phrased that there. Failed to meet success criteria. So failed?
Yep. Yeah, pretty much. Not effective enough, I guess, is what they're trying to say.
I mean, that's just what happens. I mean, a lot of businesses spend a lot of money on some things and they don't work out. And this is just an extreme example of a business going for something and they didn't quite get there in the end. They probably spent a lot of money on it as well. So, ouch.
And that's the thing. I think the lesson here is exactly what you were joking about before, is to not just blindly trust that everything is going to happen perfectly. We've seen Pfizer and what's the one that we're getting? AstraZeneca, and they're pretty good vaccines. The Pfizer one seems to be by far the best one that we've seen. But we can't just assume that all new vaccine types are just going to work 100%. And, even if the company says, look, we're getting ready to put out 300 million doses next year, 1 billion doses in 2022, you can't just trust that, yes, this is going to have a 99% effectiveness, and yes, they're going to actually be able to partner with those European manufacturers, and yes, they are going to make 1 billion doses. You can't just go, yes, that is going to happen. And I've fallen victim of this as well. Earlier on, the classic example with me is Sky and Space Global, is that I believed too much of what the management team said. They basically said, yes, we are going to do this, and then we are going to do this, and this is then what we're going to do. And I just said, you know what, that makes sense. Yep, they're going to do it. And then what do you know, a few months later, they actually couldn't do what they said they were going to do. And in that investment, I bet I lost everything. Luckily, I didn't put too much in the first place. But that's the exact same kind of story in here. You've just got to be really careful about believing every single thing and assuming that it's going to go 100% correct.
Yeah.
I guess it's a good argument for the concept of margin of safety.
Yeah. I mean, exactly. I mean, what does the company have if, say you're looking at a company that is developing a vaccine, what would happen if they didn't succeed, right? How much money would they be out for trying to make it? And what does the rest of their business look like, right? Don't invest in a company on a moonshot that they are going to produce something that they don't already now, and that even if it does work, that countries will then buy it, because it's one thing for them to develop a vaccine, it's then another thing for countries to want to buy that particular vaccine when there's a bunch of other companies that are selling vaccines as well that also work. So, yeah, I don't know. It's interesting. I always find it funny looking at these companies that make, what did they make? 50 million in revenue, and they had 160 in expenses. And I just think, look, if you give me $160, I can turn it into $48. I could do that. Does that mean I'm worth $18,000? 18?
Yeah, exactly.
So no. Very, very interesting case. I guess we'll see what happens with their full results, but I don't think they're going to be 99%.
No, I don't think so either. But poor old CureVac.
Unlucky.
It could have been great. Unfortunately not. Yeah, their shares were, yesterday they're at like $96 per share. And just in after hours trading, they've already lost $44 off their share price. So crunch. Ouch. Should we get into some Q&A? We've got a lot piling up still here. But as always, if I'll say this now before I forget at the end of the podcast, but if you do have more questions, feel free to head over to the YouTube version of the podcast and just leave your questions as a comment below the latest episode. We just add them all together in this document here and get through as many as we can each episode. Where should we start? Do you have a preference? No, wherever. Take it from the top and let's just go on
let's
down.
Start with, we'll go from the top. We'll start up here. Hi guys, big fan of the content you both put out. Thank you very much. Just a question regarding how to quickly screen a company to see whether it is a great business. I'm currently looking at historical EPS growth rate and making sure it's consistently above 10% before doing a deep dive into the company. Are there other figures that you look at to quickly identify a great business? Cheers.
I just wanted to quickly comment on the earnings per share. I actually probably wouldn't look at the earnings per share by itself. Just the reason, because you think about the number, it is earnings per share, and companies can manipulate how many shares are currently outstanding. So sometimes that can skew, they can play around with earnings per share a little bit. But I mean, I really should have a rigorous way of screening businesses. I can't say I do. One thing that I do, if somebody says, hey, have you ever seen this stock before? And I want to look into it. The first thing I do is I kind of just go to hypercharts, because they just put all of the financial data from the financial statements into charts. So you can see instantly in graph form, like the revenue growth and the operating income, the operating expenses and free cash flow and that sort of thing. So I just firstly just scroll down there, because basically I want to see that everything's going up and to the right and it looks pretty consistent, because I do look a lot for consistency in the investments that I make. So that's kind of what I do, just to get a baseline financial metrics. I just make sure that it's all up and to the right, it's working well, it's consistent. Then typically I jump over to QuickFS, because QuickFS I found is really useful. It's just got so much information right there, like the information that I think we both look at. That we like to see is right there. So you can see the last 10 years of return on invested capital to see if the management team is operating with skill. You can see the debt levels. You can see, I think up the top left is like a box of the last 10 years of median growth of, earnings per share and free cash flow, and what is it, revenue growth and that sort of thing. So I like to see, the revenue growth and the earnings per share and the free cash flow. And it's all growing very healthily over time. I like to see the return on invested capital's up like 15% consistently. I like to see low debts. And I think that those two websites are just my quick go-tos, because I think you can't get all the information at once, but you can start to form a general idea of whether this business is actually decent or whether it's just crappy. What do you think?
Yeah, I think that's really good. I'll try not to repeat too much of what you said because a lot of what I do is exactly what you said.
Go for it. Yeah, no, repeat away.
I'm first just looking at 10 years of data and looking for consistent growth in not only earnings per share, but revenue, equity, and free cash flow. Looking at the return on invested capital and how that's changing over time. Low debt companies. That's really the main things that I look at. But before I even do any of that, I'm only ever considering businesses that I've already looked into to see what the business does and make sure that I understand what the business does. Because the last thing that you want is to find a business using a stock screener that looks really good on a numbers basis, but isn't one that you really understand. And then you try and kind of just invest in the business and just fudge your way through it. But at the end of the day, if you don't understand the business, then you really are not going to have a good idea of whether it's a good business, first of all, and then whether it's cheap. So I think that's the first step before all of that. But those are some of the things.
So you force yourself to try and get a good understanding before you go anywhere else.
So this is how I do it. Instead of using a stock screener to screen for 10% growth and that sort of thing, I just start by looking in certain sectors and I just look through businesses one by one. So I look in areas that I already understand. So I'm looking at a list of businesses that I understand all the businesses or most of them in the list. And then from there, I'm pulling businesses and looking at their numbers.
Yeah, that makes sense. Yeah. That's probably the way I do it too, because there are certain businesses where if I see it floating around, I'm like, no, I'm not even going to bother. Yeah. You absolutely, definitely do. That makes sense. You want to start within what you already know. All right. Should I ask you this next one?
Yep. Go for it.
Okay, just let's have a look here. Hi, fellas. I started listening to you guys when I began investing a year ago. Oh, awesome. Good work on starting to invest. I get a lot out of your podcast, so cheers for that. Oh, thanks very much for listening. My first year investing has been volatile, and I'm currently down 10%. I don't hear many stories about being in the red. How do you stay positive? And have you guys had down years? I'm still feeling pretty positive in all, though, just a novice.
Yeah, I think that's a really good question. I think it depends on the way that you're investing and what your strategy is. I mean, if you're investing in index funds, for example, and you're just consistently contributing, then you really just have to, and it's easier said than done, but you really just have to kind of teach yourself that the markets are going to be volatile. They're going to be up, they're going to be down. You might be down in your portfolio for multiple years in a row during some periods. But if you're investing into broad index funds, you're just consistently contributing into the market, then the way that you kind of stay confident is that over the very long term, those broad index funds have historically gone up over long periods of time. And if you stay consistent with it, then you know that even if your positions are down, that you're buying into businesses at a better price than they were maybe a few weeks ago. When it comes to individual businesses, I think a similar principle applies in that if stocks in my portfolio are down, because I'm so confident in those businesses and what they're worth, it really doesn't bother me. And I think a good example of this recently is Thor Industries. Thor Industries over the past, if you look at their chart over the past 3 or 4 years, it's gone from, it went all the way up to $160 per share, all the way down to $35 per share. It went back up to $150 per share, and now it's down to $100 per share. So it has gone up and down like a lot over the past few years, but I'm really confident in what it's worth. And as a result, I know that if it falls below a certain level, I want to add more. If it goes up above a certain amount, I might be considering selling some off. So that's kind of where I sit with that. But that is all to say, I guess, to summarize, when you're just getting started, it's completely normal to feel the market much more than when you've been in the market for longer.
Yep. I would 100% agree with that. And I have felt that through my own personal experience. When I first started, I would feel bad on days where my stocks went down. I would feel great on days when my stocks went up. And that's just silly. In hindsight, that's just silly. And I think, I don't want to repeat what you said too much, but when it comes to passive investing, if you're just buying the index, then I am not concerned in the slightest if I'm in the red, because I know that even though I'm in the red now, I'm not going to sell that position until I'm 60, 70 something years old, At which time, if anything, if we see anything, if the future is anything like what we've seen in the past, then we're going to be fine.
Yeah.
So I don't stress. In fact, I feel great. I feel great when I'm passive investing and I see red, because it means that the next batch of dollar cost averaging is going to buy those shares cheaper than my last batch. Which is a great feeling. And then what you said, which I just wanted to reiterate with the active investing, is that I think whether you feel good or bad when you're down is, again, how confident and how much you know about the business. So I think that if you've bought a stock and you're a bit on the fence and you're not 100% across it, maybe you haven't quite done enough research yet, then I find that red feels very bad. However, when and it feels bad because you're not sure what to do, because you're not confident in the decision that you've made. But what I find is that if you're very confident, like what you were saying before, if you're very confident in a business and you've made an investment and then it goes red, and it might go red quite substantially, then red feels good. It feels great.
Yeah,
and I remember the example that I always draw to is me and you, March last year, when I was in Melbourne, we were up at 1 a.m. We were talking to each other because the stock market was crashing at the time, and it was all like stock prices across the board were going so red. And, the market circuit breakers were kicking in. The market was closing for 15 minutes because it had lost so much in that session. And we were talking on Facebook and we weren't scared. We were pumped.
Yeah, I was so excited.
We were so damn excited about what was happening.
Yeah.
That was fantastic. That was what a great night. And I remember you were talking about, I'm watching Hawkeye on Texas Roadhouse right now. If it drops by another $2, that's my margin of safety.
Yeah.
And we were just having a great time.
Yeah. And I mean, there isn't many businesses that I'm very confident on, but there's a few that I was extremely confident on. And when their prices go down, I really didn't feel like that was a negative thing at all. I was super excited about it. I mean, something like Texas Roadhouse, they had no debt, so they were going to be shut down for a period of time, but I knew that people loved to eat at their restaurants. They had no debt, so there's no risk of bankruptcy. And they were in a really, really good position. All that was happening.
Management's great.
Yeah, management was great, run by the founder. Yeah, exactly. So all that changed was the price that you could get that business at. So yeah, I do remember that. It was very exciting. I put a lot of money into the market in March of last year, and I feel as though not a lot of people did. There was a lot of people who did, but many people really did kind of get worried that things were going to get worse, rather than just looking at the businesses themselves. So,
to be expected. I mean, that's unfortunately, that's what happens with most investors. Yeah. They are so caught up in the short term, what's happening right now, and that really does influence what decisions they make. So, when the stock market is surging to all-time highs, they're reading all these good things in the on news sites, and they're like, "Oh, great, I'm going to invest." And then when it's horribly red, they're reading all of these doom and gloom articles, and that forces them not to invest. That's just the reality for most investors, even though it's completely backwards. It's counterintuitive, but yeah. Anyway. Should we answer? Should we finish off with one more?
Yeah.
Should we do this one?
Yes. All right. This is a fun question. You go for it.
The question is, how did you guys get connected? What is the backstory? The backstory.
Take a trip down memory
back when
lane.
I was younger.
Yeah. So I guess, I'm trying to just think of the order of events.
I'm trying to remember now.
Yeah. So Brandon had his YouTube channel first. And I was really into investing. And I came across Brandon's channel, I think when you had maybe 200 subscribers or something.
It would have been very
It wasn't
early.
many. It was around 100 subscribers, I think. And because Brandon's channel was so small, I was able to connect with him and kind of just communicate with him and talk about investing, but then also talk about getting into doing what Brandon was doing on YouTube myself. And I think you set up, I think the actual story is that you set up a Snapchat or something. And I was the first person to join you on there. and that's how we spoke on Snapchat for the first time.
Wow.
So I'm pretty sure that's what happened. And then I made my channel a fair while after that, actually. I didn't do it immediately. I think I made my channel a year after you made yours. So, but that's kind of how we got connected.
Yeah. And I think we've told this story before, that the story of how the podcast started is kind of just because none of our friends like to talk about business or investing.
Yeah.
So we just linked up and said, hey, we both do YouTube channels about investing. We're both Australian. So, let's go. Let's do a podcast where we can just spitball and, just talk about what's going on for an hour. And it kind of keeps us up to speed. It kind of has a benefit for us as well, because it keeps us up to speed with what's going on in the world of investing. It keeps us accountable to what's going on and makes us do our research. But I remember the first couple of phone calls that we had when we were just talking about potentially starting a podcast, and they went for like an hour. So I remember that first phone call went for like an hour, and I was like, yeah, it's not going to be hard to do a podcast with you.
Yeah. No, it's been really good. And I mean, particularly over the past, 18 months, we've been very consistent with doing the podcast, which is really good. But yeah, it's good fun. It's probably one of the highlights of my week, doing this podcast, just to kind of debrief and have a casual conversation about some of the things we've found interesting during the week. So it's been good. Yeah.
And sometimes, honestly, sometimes we get criticized because it's just too casual, it's too laid back. But in all honesty, that's kind of what we want it to be. We never want it to be, the podcast where there's a voiceover. And now, here are your hosts, Hamish Hodder and Brandon Vanderkolk. Yay! Live audience cheers. It's like, I just don't see us making a podcast like that. I just like the fact that it is informal. That we chat about what's going on. Some people criticize because sometimes we make mistakes, but it's like, but we're not going to be right 100% of the time. We're just trying to battle through this as best we can. Yeah. But no, it is good fun. It is good fun. I do like doing the podcast. It's a good way to start our Thursdays.
Definitely. All right. Shall we, I think we'll wrap things up there on that nice little bit of positivity. Nice question there to end things for the day and for the week. So thanks everyone for tuning in. As always, thanks to Sharesight for sponsoring. And just a quick reminder, if you do want to head over to sharesight.com/young investors, you can get 4 months off a yearly subscription. So particularly if you're in Australia or New Zealand, your financial year is about to end. So if you want to have your stock market trades all sorted for your tax time, and also just to check your performance for the past financial year, then make sure you head over to sharesight.com/young investors. Thanks, Brandon, for joining me as always.
All good.
And we'll be back.
Good fun. Good podcast.
Yeah. We'll be back next week. See you later, guys.
See ya.